Welcome everybody. So as we know, it's another share club. Basically, just before we start, just the disclaimer, get that out of the way. This is just a bit of fun that we're doing within the company. Basically, we every couple of weeks we go around and share a stock idea. It's just for some fun and for a learning experience. So don't take this as advice. We don't know your personal position and don't recommend that you buy these stocks. So with that being said, we'll go to the next one. We just have a bit of an agenda today as well. So I'm going to do the stock preso for about 30 minutes or so. And then after that, we'll do a bit of a Q&A. So if anyone has any questions, feel free to jump in then and try and poke holes in my thesis. I want to hear if I've missed anything or if you guys have any differing opinions. I'm very keen to hear what your thoughts are. And then after that, we've got this thing called Insights of the Week. Basically, just if anyone wants to share what they've been reading about recently or any sort of insight that they've found, whether it be something on GameStop or silver or any sort of trending topic at the moment, we'll have a chat about that, and that'll also be just like another experience or an opportunity for us to basically learn a bit about what's going on at the moment. So with that, any questions? No? Okay, sweet. So I'll start. My stock pick is Spotify. Full disclosure, I do own shares, just to get that out of the way first. Basically, I found out about this company a while ago, and once we knew we were going to do Share Club again, I thought it'd be a good opportunity to share why I like the company so much. And then basically, I'm going to do a similar format to what I did last time of just sharing what I look for and then what I found and then why I like it. So also, this isn't going to be a GameStop pitch, but this is a similar one to Spotify. So first off, I'll just basically go into how I found this investment, then what I look for in a company, then what I like about Spotify, the business, and then my estimated value of it, and then some of the risks I see the company's going to face or does face. So first off, how I found this investment. One day, it was pretty late last year. I think it was about August or September. I was listening to this podcast called The Rules of Investing, and it's hosted by Livewire Markets. Basically, they had a guest on there, and his name was Sam Granger, and he's from Totus Capital. And he pitched this stock, Spotify. He pitched the stock, Spotify, and I was listening to his thesis on it, and I just thought, wow, I really misunderstood this company. If the few things that he said were true, then it's definitely worth looking into further. So that's how I basically found the idea of actually buying the stock. The second thing of how I found it is obviously I use the product every day. It's not one of those companies that I would invest in where it's like a biotech or something else where I never use it. It's something I use every day and very frequently. So I'm quite familiar with the product. And then also in that same podcast episode, Sam recommended this book called The 7 Powers by Hamilton Helmer. If you haven't heard of him, basically he's a business strategist, and funnily enough, the foreword for the book is written by the CEO of Netflix, and both Daniel Ek and the CEO of Netflix have very good relationships with him. The book's basically all about how to identify moats before they're actually fully reflected in the financial reports. So one thing that I noticed that was hindering my ability to buy stocks was I was too focused on the financials, and sometimes quantitative research was getting in the way. Not getting in the way, it was just holding me back from certain opportunities. And sometimes I need to look for qualitative effects, like stuff that you can't really measure, but it's there and it's happening. So this book basically helped open my eyes to that, and then helped identify a few of them that Spotify actually has, and I'll go into them in a second. So what I look for in a company, this is the same as last time when I was talking about MasterCard, but basically just within my circle of competence. The company has to be within my circle of competence, so I understand how it works, how it makes money, how it spends money. Does it have a durable competitive advantage? What gives it a moat? Basically something that differentiates it from its competitors and enables it to remain competitive pretty much. It has to be in an industry with long-term structural tailwinds, so I don't want to invest in anything that's dying. And the solid management team, basically a team that's honest, intelligent, integrity-driven, and most importantly, aligned. I think we can find those details, but all of those are pretty important, but alignment also I haven't put in there. And then finally, just trading below my estimated valuation. So that's finally the part where you pull the trigger. So Spotify, the business. You probably all already know it, but just for a quick refresher, it's the world's most popular audio streaming service. They currently use a freemium model, very similar to Simply Wall Street actually, but except their free version has ads inserted in there as well. They actually released their report this morning, so I updated these figures just this morning, but they have 345 million monthly active users. They have 155 premium subscribers, which is basically the ones who pay the monthly fee, and it's either the family plans or the individual subscriber accounts. Just for reference, Netflix has 204 million, so they're not far behind. And their ad-supported users is 199 million as of yesterday, and they operate in 92 markets globally, so they're quite spread out across the world. Basically, the way the business works is we, the users, pay the monthly subscription fee, and Spotify per stream pays the record labels depending on what gets streamed. So unfortunately for them, that's kind of like that's obviously a variable cost, and as streams go up, their costs go up. So that's something that has deterred a lot of people, but I'll go into later why I think that's changing. So they've got multi-year deals with all the major record labels from Warner Brothers Music to Sony Music, and they have good relationships with them because before 2015, from 1999 to 2015, the music industry was really suffering. Basically, obviously illegal downloading, everything was having quite an impact on their business, and music streaming has basically just turned that around for them. So they've been major beneficiaries of it, and they have Spotify to thank for it, and they have a great relationship with them. And the company is based in Sweden, so it's a small Nordic company, but it's grown to be much bigger. And yeah, they're based in Sweden. So you can see over there, most of their customers are in Europe, and then about a quarter of them from North America, just under a quarter in Latin America, and then just under 20% from the rest of the world. So yeah, when looking into this company at first, I basically thought, and was enlightened to this in the podcast, I was like, what's the competitive advantage? They're a music streaming business, and all the competitors, Apple Music, Amazon Music, has the same catalog. Everyone's offering the same commodity. What makes them so special? Their product's pretty much undifferentiated in that sense from the content point of view. Another issue that I found that was told to me, was their consolidated supply base. So in that sense, there's about 3 of those major record labels have about 85% of the music industry. So if you're trying to earn returns yourself, it's very hard to do so if your suppliers have all the leverage. And in that next point, it's basically hard to earn great margins when your suppliers are so powerful. So in this sense, at the moment, music labels are really the real beneficiaries of music streaming. Spotify, I think I'll touch on it later, but they're paying about 70 to 74% of their revenue to the labels. So, and that only increases as the streams and users goes up as well. So it's quite hard to have those variable costs. But looking into it further and basically doing research from what that podcast enlightened me to, I actually think they have 4 competitive advantages. First one being economies of scale, second one being network effects, third being switching costs, and the fourth being brand. And all of these are covered in that book, The 7 Powers by Hamilton. But I'll go into each of them now, which one I think, or how Spotify has each of them. So in terms of the economies of scale, obviously they're the biggest music streaming company. So they have 345 million monthly active users, and they got just under a third of the market share. With that in mind, they have wide accessibility. So one of the reports I read said that basically whether it be cars, gaming devices, workout equipment, or smart speakers, you can actually access Spotify from all these different devices. And it said about 300 devices from 80 different brands. So that's quite a strong positioning in the market where you have many different ways to access the service. And that's one of their advantages that I'll get on later about how the other brands don't have that sort of wide distribution. So they're at a stage where they're reaching efficiencies and those large investments become more affordable per user. So when you want to buy a $600 million podcast company, you can distribute that cost between your 345 million users, or more specifically, your paying users. Netflix is that similar sort of business where once you get to those sort of scales, you can distribute the costs among all your users and it becomes much more affordable. One thing that we'll touch on later is that Amazon and Apple obviously can make those same sort of purchases. They're happy for music to be a loss leader for them. But the difference is basically where Apple and Amazon have provided this music service, their user experience is somewhat different, and I'll get onto that in just a second. So the next competitive advantage I think they have is the network effects. So basically, Spotify is building a platform for artists, users, creators, advertisers, and developers alike. So there is a huge amount of activity going on the platform, and it's not just a one-way service. It's not Spotify creates the content and gives it to you. It's actually, it is a platform for creators to make and list their own music and artists, and for users to interact with that music and share it and follow other people's playlists. And it's just a very big platform. So with these network effects, the more users they get, the stronger it gets. So the more users there are, the better it is for artists, because those artists obviously have more exposure to stream, more chance to earn streaming royalties, and they get more exposure. The more artists there are on the platform, the better it is for users. So as a user, you get a larger library, a greater choice, and you get more music discovery. Or you get to, for me, speaking personally, there's a few songs I've actually found on Spotify that I wouldn't have found otherwise. In saying that, they have the largest user base, and they're the most, and the fact that they're the most engaged users amplifies the effects. So one of those reports I read said that Spotify's users are 2 times more active and engaged than Apple Music users, and 3 times more engaged than Amazon Music users. So the report found that the average user on Spotify spends 25 hours a month on the platform, whereas users also spend 19 hours on Facebook and 14 on Instagram. So just for a point of reference, it's virtually a day a month people are spending on Spotify. In terms of the switching costs competitive advantage, it's quite unique, where the more time you spend on Spotify, the less likely you are to leave. So once you've created playlists, and many of you probably know it takes quite a while to create your own playlist, you can't transition them onto another platform. You can't move them onto Apple Music, you can't move them to Amazon Music. And if you did move to those other platforms, you'd have to recreate them all again. So it's kind of like an incentive to stay, because all your personalized playlists are on that one platform. The personalization curve is something that was covered in one of the reports that I read, basically covering the fact that their discovery is, the unique fact about Spotify is that it's so personalized to you. The more you use it, the less likely you are to move to those other platforms that just don't have that same sort of personalization. So the more Spotify gets to know you, the more personalized the recommendations are. And that's where Spotify, its superpower is its discovery. So basically, as you know, there's 50 million songs pretty much in their library. And just for reference, Netflix has 13,900 titles. So what's really important to do there is to have an efficient and useful way to tailor music to people's needs. Because if I was to go into Spotify and there's no discovery platform to show me what I might like, depending on what I listen to, I'm just going to get overwhelmed by the 50 million songs that are out there. So that's why their discovery is so important. And given there's 4 billion playlists on the platform, they have a wide variety of stuff that they can access and then share to you as the user. So it's well known that it's basically Spotify has the best in class discovery and the personalization tools to basically create a flywheel of demand. So the more personalized I get, I logged onto my account and it says like, oh, Michael, here's your Discover Weekly. And I go, oh, sweet, I'll listen to it. And I listen to Discover and it drives more engagement because I'm listening to these new songs. And then as I listen to these new songs and I skip some, or I listen to some halfway through, or I just skip them before they even start, that basically feeds their algorithm. And so the more data that the algorithm gets fed, as you probably all know, the stronger their algorithm gets, and they can actually then provide better recommendations. They go, oh, okay, Michael didn't like that song. He does like that song. Let's feed him more of that next week or next time. And so then the next week, my personalization is improved. And the next time I log on to Discover Weekly, it's even better. And I get provided more songs of more what I like and stuff that I wouldn't have actually found before. So that kind of user experience is really what separates them from the rest. And they also found that basically 1/3 of the listening time from users was spent on Spotify playlists that they actually created, and 1/3 of listening time was spent on user-generated playlists. So if I have an account and someone else has an account, I can actually follow my brother, for example, and see what his playlists are and follow them. But yeah, those switching costs, I think, really embed the user into the platform. And once you're quite ingrained and you've got your playlist created and your suggestions are really personalized, it's quite difficult and you're quite unincentivized to leave. And the fourth one, I think, was brand. I think they have a competitive advantage in the sense that everyone knows, the vast majority of people know Spotify, and they know not only what it's about, but just how good it is. So we found, or they found basically, that every user who uses it is high frequency and they don't switch, which relates back to that previous point. So one of the things that Spotify talked about in one of their, I think it was Q3 last year in 2020, basically 70% of their premium users who unsubscribe from their service then resubscribe within 45 days. So that just basically sort of supports the fact that it's like everyone loved the experience on the platform and on the app, and that they were that incentivized that they missed it so much that they came back. So yeah, to that same point before, the more the algorithm gets to know you, the better the offering and the suggestions are for your experience, and the more likely you are to stay, because it's just a more enjoyable experience. But from a brand point of view, it's a music-centric brand. So everyone knows that Spotify's bread and butter is music. If I was to ask you about Apple Music or Amazon Music, it's like, oh yeah, Apple sells devices and they offer music. Or it's like Amazon is a retail outlet or online e-commerce giant that also offers access to music. Whereas Spotify is 100% music streaming. And basically with that, they know that music is kind of like a passionate sort of industry. And I think people really appreciate that. And the brand that they've built stands up for that sort of perception that everyone has of them. So their user experience and the music discovery and curation basically aligns with just how fixated they are on being the best at music. So one of the reports I read basically says, Spotify feels like the music gig at your local record store guiding your browsing. It's kind of like they're really in line with you and they just want you to have the best experience possible. And the other ones, while they provide the commodity, they don't do it in a way that's as personalized as Spotify. Just the next thing on brand was having a look at the reviews on all the app stores. Basically, you can see there Spotify had 1.8 million reviews on the App Store for an average of 4.7 stars, 21 million reviews on the Google Play Store for an average of 4.5 stars, and then Apple and Amazon Music respectively just didn't seem to come close. Now, fair enough that Apple Music, you can't rate them on the App Store, but from Amazon Music on the Apple and Google Play, App Store and Google Play, just the reviews and the brand image weren't as strong or didn't have as many submissions. So reading through the reviews, people really liked the experience. In regards to the industry tailwinds, basically, the report that I read found that we're in the early days of market penetration. So of the 3.5 billion smartphones that are out there, it's roughly suggested that almost each one should have some sort of access to a music streaming service, not necessarily a paid streaming service, but just like a music streaming service. So given there's about 400 million currently, we're about 11% market penetration, and this is mid last year. So we're still pretty early days. There was a report I read that found Goldman Sachs and Morgan Stanley expect the paid music streaming industry subscribers to be about 1.2 billion by the year 2030. So if you look at the 400 million now, and in 10 years time, it's expected to be 3 times that. The two-sided marketplace. Now this is something that's kind of new and really adjusts the current dynamics of the music industry. At the moment, you have a consolidated supply base with all those big music labels. And what's interesting about the two-sided marketplace is it's something, in case you're not aware, it's something that Spotify's launching. And basically the idea is that rather than listeners being able to just listen to the streams they want, it's now giving artists the ability to target those users they want. So they're providing the idea of you, I suppose effectively could do it as a Facebook marketing. So it's kind of like you're the artist and you're like, hey, I produce indie rock sort of music. I want to target indie rock sort of people. And Spotify goes, okay, we know where they are. Do you want them? And then Spotify sorts out for that artist. I think they will pay a fee, and they get exposure to those users who are actually potentially really interested in that kind of music. And that there is an industry that's only really just, it's a dynamic in the industry that's only just kind of started, and it's, I believe, really going to change and be a huge beneficiary for Spotify, and they're the ones leading it. So that's, I think, going to change the way music is consumed and people are targeted for music. So typically you would, as an artist, you would have to go to radio or on TV events or concerts or whatever to reach your fans. Now you can reach not only your existing fans, but you can reach new fans with all the data and scale that Spotify has. So that's something that I think is a really really big positive tailwind for them. The next tailwind, I suppose, is the same to that point of the artists and creators that deconsolidating the big three supply. So my friend, for example, Marty Wilson, shout out to her. Sorry. She's an artist at the moment, and she has the ability to put her music out there on Spotify. And as more and more individual artists do that, they're basically deconsolidating the power that the big three labels have. She's not on a label. She's an independent artist, and she, as more people do that, basically the three who currently have the majority of the power, their power will dissipate, and the independent artists will be the ones who are more of a majority of the supply base in terms of music. And then the next thing is Spotify, as a lot of you probably already know, is they're getting into podcasts as well. So podcasting is still in its early days. I think about 20% of their users listen to podcasts at the moment, and it's woefully under-monetized. So at the moment, it's still just scratching the surface and trying to get scale. And just for a point of reference, radio currently generates 4 times as much revenue per hour of listening than podcasting does. So if podcasting does continue its trajectory of growth, then I can expect that will change. And Spotify is in a good position to benefit from that. And interestingly, their fixed costs, as I mentioned before, they're very variable costs where they pay the labels. Their fixed costs, for the most part, are likely to replace a large portion of those variable costs. And that's similar, for a point of reference, to Netflix with its licensed original content. So as Netflix started making its own content, it didn't have to pay it was paying less and less of these licensing fees because it actually owned the content itself. And that gave them much better economics. So they got to keep more of the money that they made from people's monthly subscriptions. And Spotify is going in a similar direction. Similar with the Joe Rogan podcast experience that they bought, and the Kim Kardashian podcast, and the Michelle Obama podcast. They own all of that now, and from that point of view, that's a benefit for them. Just roughly on the financials, or quickly on the financials, they, as most of you probably already know, they're not profitable, and this really interested me. So I actually wrote an article about it mid to late last year, basically explaining how, yes, they're unprofitable, but if you look at their free cash flow, it was growing like crazy. It's had a pullback in the last couple of months, but the idea is, I listened to the CFO and he spoke on another podcast, and he basically said that if you exclude the non-cash expenses, they're running at around break even on purpose. And this is the thinking behind that is that they want to pursue growth, and they don't listen to Wall Street. So pretty much they have the ability to turn on the profit if they wanted, if they really did reduce. Not only if you exclude non-cash expenses, they're at about break even. But if they wanted, they could reduce their investment into the data and the AI. They could reduce their investment into marketing. They could reduce their investment in the general admin, and they could actually turn profitable and start generating a profit right now. But the CFO and Daniel Lake, the CEO, and everyone else realizes that the opportunity that they have in front of them for the next 10 years is way more important. And to liken it to something similar, it's basically Amazon in 1999, where they're like, yes, they were profitable, and not 1999, but early 2000s, where it's like, if we want, we could start distributing money to shareholders, but the opportunity in front of us is too big. We have to keep reinvesting. And so from a balance sheet point of view, it's looking healthy. As you can see there in the chart from simplywallst, they have no debt, and they haven't for the last 5 years. The financials, as I mentioned, their cost of revenues is still very high, 74%, and that's all because of the current royalties that they pay to the music labels. And then the 2 points, is currently loss making, but the free cash flow positive. So to get into it very briefly, they accept the money up front, and as in the user pays for the month in advance. And the way that that's accounted for in the financials is it's deferred revenue. So they have to then earn that revenue over the course of that month. And that really, those few points there underneath the free cash flow positive, it makes it look different to what the underlying business is. And I'll try and find a link to my article, but yeah, that explains why it's actually free cash flow positive. And then from a ramen profitability point of view, it's just a comment, point I read somewhere, but it was the idea of if you had to turn all your expenses off, all your growth expenses, and just dumb it down to the core business, would you be profitable? And the idea with them is, yes, they would be. So the business model there in itself is sound. And then on to management. So as it's still run by the founder, Daniel Ek, and encouragingly, he owns 8% of the company, which is about 5 billion euros as of today, I think. And what a lot of people, a few analysts like about Spotify is that they ignore Wall Street. So for the point of what I just mentioned, where they could turn off, or they could turn on the profitability. Daniel Ek and the others have just gone, no, like, we're not going to do that. And the opportunity in front of us is too big to ignore. It would be taking short-term profits for long-term profits, and they're focusing on the long game. And that's one thing that makes Daniel Ek really unique. He seems to be an incredible CEO and operator in the sense that he can focus on the long game, but also execute incredibly well in the short term. So yeah, they're incredibly focused on what they want to do. They know they want to be the all-in-one audio platform. And the fact that they're not trying to differentiate from that and diversify and reduce risk, they're going all in on the one industry, is quite reassuring. And they know that basically in a space where internet platforms, it's often the biggest fish wins. They know that they're in that game, and they're incredibly focused on being the dominant player. Virtually every investment they make is geared towards user experience. So whether it be the content that they buy, or the platforms they buy, or the investments they make in terms of what it's like to use the app, it's all geared towards user experience, because as mentioned before, they mostly deal with a commodity kind of product. Everyone has access to the music. It's just more about the user's experience. So Daniel is very patient in building that wide moat of those 4 points that I mentioned earlier. Same thing. So they're deferring profitability now to pursue scale and dominance in the future. Very focused on long term. I read that they're running thousands of experiments, and Daniel's mentioned in one of the reports last year that they're running thousands of experiments, just tinkering and tailoring with the user experience, trying to make it as good as possible. And they also have a similar culture to many successful companies, where they're a culture of day one. We're always in day one, and we're always trying to do just innovate and do as best we can to grow. And interestingly, there's a transaction that Daniel did where he spent, I think it was 2019, where he spent $16 million of his own money on 800,000 warrants that were expiring in July 2022 at $20 each. So for him to break even, the stock would have to be trading at 210. And back then, he was basically bought them when they were 50% out of the money. So the fact that he spent his own money and they were incredibly out of the money just signaled that he was very bullish on them. And they're in the money now, obviously, but that kind of CEO alignment and even purchasing while he's already still a huge owner was a very encouraging thing to see. So basically my thesis is this: I reckon the deconsolidating supply base will improve their margins. I didn't mention on the financials page, but their margins are quite low. Their gross margins are about 25%, which all things considered is pretty average. So what CFO Paul Aaron mentioned, Vogel mentioned, was that a couple of years ago, the top 90% of listening was from about 16,000 artists. Now that's at about 32,000 artists. And as of 2020, that was 43,000 artists. So what that means basically is that from all the original, like the same ties back to that same point of all the power to the music labels. And what we're seeing there is, like, of those 43,000 artists, a lot more of them are independents, and they're not sending all that money to the labels where they take a larger cut. They're taking them directly to the independent artist. And what you guys might find interesting is that Chance the Rapper and Metallica actually have deals directly with Spotify. So Chance the Rapper is an independent artist. He broke off from his label, and Metallica did the same thing in 2012. And interestingly, last year, Metallica had 99.3 million hours of listening time, which basically translates into, this was just in 2020, basically translates to, if you started listening to their music in the year 9318 BC until last year, that's how long how many hours worth of content people consumed on Metallica just last year alone. And that's insane. So yeah, my thesis is Spotify's original content, being podcasts and audio content in general, like audiobooks, improves their gross margins. I think their user base will continue to grow as it is. I think they'll remain the dominant player. I think they'll add new revenue streams. So that two-sided marketplace, I think that'll be very beneficial for their top and bottom line. And I think their advertising, yes, it's not huge part of their business at the moment. Like advertising, ad-supported revenue from those users are only about 10%. They make 90% of their money from premium users. So I think that they'll add a few of those new revenue streams, which will just help the top and bottom line. I think their pricing power lever, they haven't even switched on yet. So they'll only do that once they reach scale. So as you guys probably know, that basically these internet companies, once they reach scale, then they start to monetize. And there's that economic concept of basically consumer surplus, where it's like what the consumer perceives they're receiving in value versus what they're paying in value. And at the moment, I don't know about you guys, but the majority of research from people is basically that their Spotify, the fee that you're paying per month, you're happy to pay it, and you in fact you think you're probably getting worth a bit more than that. So you'd probably be happy to, or you would potentially be happy to pay $15 a month if you wanted. And the idea is that Spotify has that lever ready to switch on if they want, and they won't yet until they reach scale. And when they're providing massive amounts to users, and then they say, look, we are going to turn it on, we are increasing our prices by $2 a month, $3 a month, people go, oh, okay, whatever. Like, you know, this is a good service, fair enough. And that just ties back to the stickiness of the user base before. So the fact that they keep coming back and they're such high intensity users, I think they'll be able to do it. And then my other thesis is that podcasting increases the percentage of listening time. So it's roughly about 20% of people, 20% of the users on Spotify listen to podcasts. And for their listening hours, it's about, I think it's about 30% of their time, like once a week or a couple of times a month. And I think as a percentage of someone's total listening time, that will increase. And as someone listens to podcasts more, it means they'll be streaming music less, or as a percentage of their total listening time. So that will help again with their margins as well, because they'll have that same user paying the same amount of money, but they won't be sending as much to the music labels. And so in light of that, I think the average revenue per user will increase. So valuation, I've basically done my best to try and estimate 3 different scenarios. So I've done, because I found it difficult to precisely value the company. So given its early stages and there's so many initiatives they're trying to chase. So I basically proposed 3 different business scenarios. So like a worst case scenario, a most likely case, and then a best case. The worst case scenario, and this is all for the year 2030. So I mean, what do I think the business of Spotify will be like in the year 2030? At the moment, as you guys, and this, the 10% there means I think there's a 10% chance that this would happen. I'm going to assume in a worst case scenario, they have, worst case is the business just goes out of business and just doesn't exist anymore and is dead. That's very unlikely in my opinion. So I've got this as worst case scenario, but that is obviously below that. So in this scenario, I say that they have about 20% of that market share of those 1.2 billion paid users that the Morgan Stanley and Goldman Sachs think the market will be in 2030, which means they have 240 million paying users. And if they currently earn about 4.5 euros per user, revenue of 4.5 euros per user, if I'm going to assume that stays the same, so that's per month as well. Which means they would generate 14 billion in annual recurring revenue, euros again. Their gross margins are currently 25%. Let's just assume that plays out where the deconsolidating supply base does happen a bit and the podcast content is a bit more. So their margins only increase, gross margins only increase about 5%, which means that their gross profit would be about 4.2 billion. And just for a note, that's double what it is today. And then the next assumption was that they have net margins of 5%. So as you know, they're currently not profitable, but in this case, I assume that in 10 years' time, they have reduced their marketing expenses, they've reduced their R&D just a little bit, not entirely, but just they're less of a percentage of what they currently are. And that means that basically if there's a 5% margin, net profit margin, it's $700 million in net income. So for perspective, that would be a multiple of 68, price to earnings ratio of 68 of what the stock is currently trading at today. Most likely scenario, so that's just, that's just pretty much the worst case scenario. Most likely scenario, what I think is 50% chance of happening in 10 years time is, let's just say they retain the same amount of market share. So they've got 33% market share of the 1.2 billion users in their market. That means they have 400 million paying subscribers. And for the average revenue per user, this let's assume it goes up to 10 euros per month. And that going up because of the increase in advertising spend that happens on the platform, the increase in revenue from the two-sided marketplace, and the potential for them to turn on the pricing lever and increase the subscription price per account, whether it be family or individual. So let's just say they make 10 euros per account. Annual revenue, that would make it 48 billion. And let's just assume they get to 35% gross margins, which is the same of same thesis of the deconsolidating supply base. That would mean they get 16.8 billion in gross profits. Now, in this case, I've assumed 10% net margin because of those more favorable economics that come from the less money spent on trying to grow. So they spend less on the R&D, less on marketing. Marketing is quite a large spend at the moment. They spend less on that, and let's assume they have a net margin of 10%. That would give them a net income of 4.8 billion, which, for perspective, would be a multiple of 10 on today's current price to earnings. So if you would look at 10 years' time and you say, do I want to pay, so the company is currently valued at 48 billion euros. Do you say, looking at the company as a whole, do you go, do I want to pay 48 billion euros right now to be earning 4.8 billion in net yearly income in 10 years' time? Now, there'll be income before that, obviously, but just as a screenshot of the year 2030, would you pay that? And the best case scenario in 10 years' time, and I think there's probably about a 40% chance of this happening, this is when a lot of those things go in their favor. So let's just assume that because the music streaming industry is still sort of early and sort of breaking in, let's assume that Spotify gets up to 50% market share. Now, that's very, very optimistic, but I think it's very possible. That would mean they have 600 million users. And let's just assume that same thing as before, but they're making 12 euros per month per user in revenue. That would give them 86 billion in annual recurring revenue. And let's just assume the gross margins go up to 45%. And that is like the best case scenario. You don't have as much money being sent out for cost of revenue to the music labels, and you've got a much more original content, and it's less reliant on the suppliers, and you're actually holding on to more of the money yourself. Your revenue costs less. That would mean a $38 billion gross profit. And let's just assume 15% net margin with the same assumptions as before, but a better case. That would make them be earning at that time 12.9 billion in net income, which, considering they're currently worth 48 billion euros, is a PE ratio of 4 from today's price. So when you look at it that way, it's quite appealing. Now, just to sum that up, basically, most likely case, I think, is a 50% chance of it'll get to there. Now, these three valuations here, they all assume a price to earnings ratio of 30. You can input and change them for sensitivity analysis, but I personally find it very hard to try and value what the market, or perceive what the market will value the stock at in 10 years' time. So I've just made these assumptions of, let's assume they're all trading at 30. In that most likely case of that income, the company would be worth 144 billion. In the best case scenario, the company would be worth 387 billion euros. And in the worst case scenario, it'd be trading at worth 21 billion. For perspective, the current market cap is 49 billion. So those are just my assumptions. I think that there's like a 90% chance that it will be somewhere in 10 years' time, the company will be somewhere between that most likely case and that best case. Again, these are just my assumptions, but that's just from what I've read and what I believe to be the probabilities of those things occurring. That's what I think is most likely. And then just to finalize really the risks, it's probably obvious that they're very vulnerable to the big players. So Amazon, Google Play, and the Apple Store. As we've seen with Fortnite, if you do something that the Apple App Store doesn't like, they could take you off. So there's just worth keeping that in mind. They're being outspent by the big players. That's another big risk. If, like, yes, Spotify is spending a lot on content, but there's a chance that Apple or Amazon might look at this and go, you know what, we actually do want to be dominant in this field too, and then they just ramp up their spending. At the moment, they're just kind of producing it. From Amazon's point of view, they just want to keep people in their ecosystem. From Apple's point of view, it's basically like a nice add-on service to add additional revenue, and they've already got access to the content. And for YouTube, it's interesting. I don't think they'll actually do well because they pay, from what I've heard, it's not as favorable payouts to artists on their content. There's a risk that the music labels pull the content. I don't think that's highly likely of happening because of the deals they have with the labels. Because the music labels are benefiting so much from Spotify, I think it's very unlikely that they pull their content. There's a risk that they have unfavorable terms with the music labels. Again, I don't think it's very likely. There's a risk that competitors innovate and create a better user experience because they see what Spotify is doing. There's a risk of foreign exchange headwinds because of what's happening with currency markets. And then there's a risk even of streaming being ousted by something else like that I'm not even aware of yet. And then also finally, just a black swan event that I'm not even aware of what could be, but there's a risk of that happening. And then, yeah, here's just some of the sources that I used to get some stuff. There's that case study I read. It was a fascinating read if anyone wants to read it. I get my info from Simply Wall Street, quarterly and annual reports, Seeking Alpha, and on Spotify itself as well, which is kind of funny. But yeah, that's pretty much my stock pick.